people come from different roles within a traditional economic development lens, and this is a bit different, the Opportunity Zone framework. And we thought it might be helpful for folks to see themselves and some of the players within the ecosystem of Opportunity Zones. So we've assembled a distinguished panel, 4 folks here today, and what each of them does during their day job is plays a role in the span of what I would call this new ecosystem. And we're very deliberate about how we've asked the panelists to sit, because there's a traditional sequence of how capital flows. So with that, Jim, share with us how private capital thinks, and tell us a little about yourself.
I should just warn you, I'm one man, one investor. I don't know how representative I am of other potential investors. And frankly, I'm an investor in asset categories which are different from opportunity zones, obviously because they didn't exist until recently. And I am, like I'm sure many people, considering investment in them. Now, I mentioned I'm one type of investor, and so let me make this very clear. I invest to make a return. I personally don't care about the social benefits of investments that I make. Now, you might think I'm a greedy Scrooge, but in fact, I've given away 25% of the net wealth that I've ever achieved in my life. I intend to give the remainder of my wealth over the course of my life or when I die. But I'm going to be choosing what philanthropic efforts I wish to make. But if I'm going to be a generous philanthropist, I got to be a rich philanthropist. So when I invest, I got to make a good return. So my way of viewing the Opportunity Zone is that the federal government has created yet another tax loophole for rich people like me.
If I may, if you're thinking about various real estate opportunities in the state of Minnesota, who might you normally turn to help make those and create a return?
I would turn to a developer.
I'm Ravi Norman. I'm the CEO of Thor Companies. We are a turnkey real estate firm headquartered here in Minneapolis with 7 offices around the country. I believe, according to Black Enterprise, we are the 11th largest African-American owned business in the country. And in 2017, we're the fastest growing African-American owned company, irrespective of industry, year over year. So we're always thinking about blending social, environmental, and economic returns. So much so that we already have a pipeline right now that we're either co-developers and or singular developers of between 800 million to $1 billion already in opportunity zones as we speak. A most recent example for us, of course, is our new $36 million headquarters building in North Minneapolis. People said I was pioneering in doing what we did in North Minneapolis, and pioneering is really great for like articles and marketing, but it's terrible in a room of finance people because they actually perceive certain levels of risk. And even though I thought above and beyond to try and prove out that it wasn't greater risk. In fact, there was market rate returns here. There was a way for us to be transformational and, oh, by the way, create a certain type of cascading multiplier effect on the social return side. It was still very difficult to pull the capital together to get the deal done. So my hope is that you're going to have kind of the table stakes. To Jim's point, we are going to have to be able to make cases that the minimum economic thresholds are there to attract investors, risk adjusted. But I do have deals, of course, in that $800 million that I referred to that are in opportunity zones. An example is Upper Harbor Terminal, which is 48 acres on the river that we have in a co-development with United Properties and First Avenue. It's a great opportunity, I think, for a destination center along the river. And the river is a unique asset that provides an opportunity for us to, I think, do something that could be a regional attraction.
Ravi, I'm going to pause there because you spoke to a lot of ways in which you're working with others. And one of the groups you're working with is the city of Minneapolis. Sean, do you mind speaking to how that came about and how you helped enable private capital into a project that was important for the city?
So I'm Sean Pearson. I have the pleasure of serving the people of the city of Minneapolis as Mayor Fry's Director of Economic Development and Inclusion Policy. And I have also had the pleasure of sort of being next to, adjacent to, and supportive of the Upper Harbor Terminal project for a couple of years now. As a city, we're really committed to dismantling the disparities, but more importantly, creating and reinvesting in communities who've been invested in themselves for oh so long and not getting their returns. The city of Minneapolis was really focused on making sure that we designated our opportunity zones tracts in areas where we had quite a bit of publicly owned land. And we did that for the reasons that we've already heard today. There's a lot of conversation about people self-certifying and creating funds. There's a lot of conversation about people just being able to come in and be driven solely by profit and returns, and that's really unacceptable in a state and in a city where our disparities are so high. So we know that as the public entity that has land use authority, we have some say over what happens if the tracts were designated around publicly held land. So if you look at our city, that's what you'll find. We don't expect that in our city you're going to see very many people just coming and buying properties in opportunity zones without some really heavy conversation. We're currently prioritizing a few things. One, we want to partner with a fund or funds that have a social impact approach. Bottom line, there are at least 6 funds that are popping up already in our market. You can do whatever you like. We think we're better together. So have conversations with each other, find out who has a fund, and figure out how you can be a part of that fund. Because we want to be able to drive resources there. We have loan dollars, we have grant dollars, we have relationships, we have land use authority, we have the planning commission, we have tons of partners that we can actually bring to a fund that is going to result in the greatest benefit for the people who are already in community. We have tons of people who are already making investments in what people call distressed neighborhoods. And we simply haven't had a vehicle to get an equity investment to those people ever at this scale. So I think our role as a city is to make sure that the equity lands with the people who've been doing the work for the last generations, and make sure that the investors and the developers that we partner with have the foresight to know that that's actually how they're going to see the greatest return.
I'm going to ask you to pause because, Stephanie, you and your firm spend a lot of time in this kind of negotiation.
Mm-hmm.
Help us understand the ways in which you can bring goals and ensure outcomes.
Good morning, everyone. My name is Stephanie Lewis, and I'm the Strategic Partnerships Manager at Social Impact Strategies Group, which is a public benefit corporation. And my lens is social impact. So it's, we're brought into the conversation either proactively at the beginning of these projects, or when people are still in the thought, the idea stage, or reactively when somebody have made a boo-boo and now they have to figure their way out. When we're talking about these projects and opportunity zones, and I was talking to a colleague of mine yesterday that works in housing, it makes people very nervous, right? Because it's just almost like a blank slate of what you can do. And the federal government did not give any guidance on really how to do anything. And they certainly didn't give guidance on like social impact and what does that look like. And so I'm really committed when we're talking about opportunity zone funding, making sure, like Sean said, that there's equity, there's intentionality behind the project, and that we're really proactively looking at what kind of social impact there will be, and that's starting, saying, okay, what is my social impact thesis? And there's no one right answer. If you are committed, if you say, hey, this tract of land over here, we see opportunities for education, okay, then let's talk about that. Mm-hmm. What are our outcomes in the beginning? And then let's talk about the inputs, let's talk about the activities, and let's create metrics based on that. We're there to advise and to guide, but not to tell you, what you should do. That's what we do. We work with nonprofit organizations, we work with private investors to really, target what you want as social impact. And so I think that's the goals that we consider an achievement when we have hit the metrics, when everybody at the table, when we gather people at the table, that everybody at the table feels good about what we're doing and has some direction and has a real strategy and a real framework about the impact that we're going to create with this project.
Almost every community has a plan. There's an awful lot of activity going on in the city of Minneapolis about a plan. Mm-hmm. Is that plan likely to be specific about projects and opportunity zones, or how do you now translate this deliberateness into the things that are going to be funded kind of up the stream here?
The clearest overlap that we'll have from a planning standpoint, a land use standpoint, and a policy standpoint with opportunity zones is likely going to start with the embedding of cultural districts within our comprehensive plan. The cultural districts will provide a framework for our teams across the city to hopefully be more responsive and to really support the investments that are coming in so that we can make sure that those dollars actually hit community. So often we have great concepts come to us, like the vision is beautiful and the mechanics are lacking. So for this to work, for people to be able to effectively invest in a fund, you're gonna have to put together a pro forma. You're gonna need to think about those projects. You're gonna need to think about that end result. That's the same type of material that we as a city always need to be able to say yes and to be better partners. So it's a win-win for us.
Ravi, tell us a little bit about what does a developer do? What sort of guidance and inspiration do you offer some of the other folks here who are in that same community of developers?
We're not going to get the transformational triple bottom line results without a really intentional cooperative model. And so what I'll say in opportunity zones is if it's not a intentional cooperative model and it's just left to developers and just left to investors, you're not going to get a big transformational outcome. In fact, you might get more displacement and gentrification than we are bargaining for. That's my personal opinion. I actually think the philanthropic and nonprofit and municipal communities can do some really interesting work that needs to be getting done right now, especially now that the regulations have come out and funds are going to be popping up all over the place. I know at Thor it's very difficult to do all that I want to do in terms of the data collection and the asset mapping that I think needs to be done in early phases to get all of the input that's necessary to get all the voices at the table from the community to understand what their dreams are, where they are today, plus the sequence of what they want across their fullness of their humanity too, because not only is it financial, but it's physical health, it's emotional health, it's mental health, it's spiritual health and wealth. How do you get that kind of information that can be fed into a developer to make better conscious choices, who's then driving the development process, the design process, the build process, the manufacturing process, all of the supply chain activity. When I'm sitting as a developer trying to articulate to an investor a triple bottom line approach, one of the reasons they default to economics right away is it's easy to quantify. It's easy for them to interpret around the risk. When I start trying to talk to them about, well, here are these other mechanisms of value that come with my philosophy or investment ideology, they start getting into, well, that feels softer. You don't have enough data or quantitative models for me to feel comfortable that that actually is going to get this type of yield when I make this investment. And honestly, a lot of times the developer doesn't necessarily have enough, either the staff or enough in the data to be able to prove it out themselves, even if they believe it from an ideological standpoint. So we need the support. We need the cooperative model of the places where we can be getting that data, because that data feeding into us becomes really critical when I start to talk to an investor to say, I'm going to give you this type of return. Understanding that, to Jim's point in the beginning, I'm not going to bring a deal that makes no economic sense. If there has to be some economic threshold that makes it viable.
Roger,
However,
that's a good transition back to what's the minimum? What does a project need to produce?
I like that question.
The minimum is what competes with other alternatives. And you have to discount for a holding period of 10 years, or if you drop it before 10 years, you've lost the tax advantage. You have to have had capital gains, which you want to redeploy. It has to be as risky as something with the same return or less risky for such return.
So if I may, and I'll just put a couple numbers. So many investors who are large-scale accredited investors put a portion of their money in bonds. Some who have a high tax rate use municipal bonds. If I remember my newspaper yesterday, because I was up too early, the 10-year bond, the Treasury bond, is about 3% right now, 3.25.
Yeah.
And the an equivalent municipal portfolio would be upper fours. The long-term return on the stock market is in the mid-12s. So if you're getting really, really excited about a 2% return project, that's probably not going to cut it. If you've got a project that's a 20% return project, that starts sounding pretty interesting. From what I'm hearing from the investor community, something that starts in the double digits and it might go from 10 to 15-ish. If it's got the good location and is well thought out and is very interesting, that's going to get some attention. So with that, let's open up for some questions. And
Thank you. I'm not a finance person, but I start looking at this new opportunity fund, and it's like squeezing a balloon. it's going to grow here, but it's going to have effects in other areas. So how does that?
Can you say more about what you're referring to? You say effects in other areas.
So right now, if you have capital gains, you pay taxes on that. So the tax dollars go to work. Or you have another alternative is putting it in a foundation or a fund that benefits communities in other ways. So this is a new way to invest your money that has, and hopefully there's good oversight on the social impact, but it doesn't create more money. It's just redirecting the money, and I want to see how that really benefits the neighborhoods.
The thing to remember is that money wasn't hitting community before in this way. So we're going from zero to a possibility of trillions across the country. That's how I like to think of it. So there are people, and also I'll just say there are a few things to remember about this. One, you need to have investor profiles that you want to attract. Michael Polanski is going to advise his clients differently, right? And he happens to be a part of the cohort that created this thing. So that's one. I also like to remember that a lot of times when we're trying to structure deals to do the bricks and mortar stuff to invest in our businesses, we're dealing on the debt side of the equation, and many of our communities are struggling to get the equity side up. So again, we're going from really zero and like personal collateral and that sort of thing on the equity side to a possibility of trillions across the country. The third thing that I think is important here is that in our market, we have a very close to the chest, you have to be in my network sort of way of doing business, right? We like to pretend that we're competing with each other. And as I was talking with Mayor Fry and we were talking with the council members about how to designate, I had to keep reminding them that now Minnesota's competing with the rest of the country. So the developers that are nervous about working with each other, you're probably better together. The fund managers that are nervous about working with each other, you're probably better together. 3 months ago, I started getting inquiries from all over the globe about how we were designating and where they were going to invest. So we're going to be better together if we're really serious about going from zero, again, we had zero for the most part, publicly, right, to the potential of trillions.
I think this is for Jim or Ravi. Can you talk about whether or not having part of a capital stack that has a first loss or credit enhancement from philanthropy or from government makes the investment feel more safe or more attractive in some way?
Well, it certainly does to me. I mean, anything I think that you can put into the capital stack that improves what the equity position looks like. And, I can tell you when people are making a risk evaluation, they like to feel like I'm not the only concentrated money in the deal. So if you can show them that there are a variety of players that are in the deal, it starts to mitigate some of their feelings of risk that, okay, and if you get to a threshold where equity can be increased relative to the equity debt formula, then you're going to improve your probability of getting a deal done. And what's nice about the opportunity zones, as Lauren talked about, is it can be stacked with other tax programs. So, of course, in my most recent deal, New Market Tax Credit played a significant piece of being able to bring what it was, in essence, quasi-equity into the deal. This is an opportunity that you can stack some of those things on top of each other. So it just adds another arrow, I think, in the quiver.
In case you haven't heard, we're about to have a new governor. And I'm just curious if you're able to talk to the new governor or his staff. What would you say about opportunity zones in terms of, the state needs some work on the tax code, obviously, in relation to the Tax Cuts and Jobs Act. And I think that there's potential for the state to look at some incentivizing to make sure that some of these positive equity investments can be had. So are there any ideas out there? You have any personal opinions you'd be willing to share about what that conversation should look like?
The whole point of this is, this was a bill passed by Republicans for rich Republicans. It wasn't that money could go to the government or elsewhere. The idea was the government would take less taxes and rich people would pay less taxes. That was the whole idea about it. You are here not because you're rich people wanting to take advantage of a government handout.
Right.
You're here because somehow it got through, and now there's an opportunity to use money to develop communities. And for sure, we heard about the multiplier effect. For sure, now that there is this opportunity to have the state play a role in putting a slice in, and we've talked about a capital stack, which makes it more attractive for the pure equity at the bottom. Anything that the governor can do to aid in this, to create more of a multiplier, that's a very, very good thing. So that's what I would say to the governor.
I'll just say there are a few things that do need to happen at a state level, and I think it's quite a bit beyond just the governor. We know that in housing, for example, we need to figure out how to deal with the affordable housing crisis, how to make sure that we have capital coming in. And some of those things are not really answered at a local level. They are about how we do cost sharing and those sorts of models. The other piece is, I'm thinking about this from a business standpoint. And if I have a company that wants to expand or wants to relocate to the Twin Cities and they want to locate into an opportunity zones or expand in an opportunity zone, right now there's a little bit of a hiccup at the state around different incentives. Those are some of the things that could be created. The other reality is that as our businesses are scaling and as we're looking at more upstarts, many of our companies are in need of operating capital, not necessarily real estate capital. So there's a question about how we might be able to leverage opportunity zones to take care of the real estate portion and then free up public dollars for actually operating costs, which tends to be the difference between your additional 2 to 3 engineers to grow your company to even make the real estate transaction.
And I'm sorry, from an impact measurement perspective, I think because social impact measurement is a relatively new field and there's really no standardized, data or standardized metrics, I think the government, the state government can definitely take the lead on working with those folks who do the data and create those standardized metrics so they can demonstrate that we have social impact in these certain projects. Because if you allow people to just develop their own metrics, you could say this one is successful over here, but then compared to what? So I think we also need to come up with some standardized metrics around that, and then, then put that out there for everybody to say, okay, you have to have these built into your model. Especially the ones that are being used with municipal funding and stuff like that. You have to have these baked into your model in order for you to really demonstrate social impact.
Jim made a really good point about it was passed by a Republican president and legislation for the benefit of probably a very homogenous group. So I would ask, what is the underlying hypothesis in Make America Great Again? Because that has a tenet of nationalism, and it has a tenet of America. So then the question becomes, how do you make America great when there's roughly 325 million Americans, and there is, go to China, how many people? So on a parity basis, we're not gonna win unless we get more productivity per person. And how you make America great is you're gonna have to unlock the potential of the base of the pyramid. Those peoples, those families, those neighborhoods, and the outputs that come from them, which the opportunity zones gives us an opportunity to invest in a way where we're very intentional about that. So I would say, if the Republican who wants the tax loop that is starting to talk about wealth, then it can't just be a conversation about global funds and economic returns. It has to be, how do we make truly America great again? And it's the unlocking of the base of the pyramid and the bottom middle of the pyramid that's going to get us there, and that's how we can do this together.
Thank you very much. So thank you very much, panel.